All right, welcome to Acera's Mid-Career Seminar. I've actually renamed it this morning to Acera's Mid-Career / New Employee Seminar because in this seminar, we're assuming you're not quite in your retirement yet and that retirement is still a ways away. And so it's pretty much the same information. So even though your retirement is not coming up soon, what's good about that is that it means you still have plenty of time to plan for your retirement. So in this seminar, I'm going to tell you all the things you might want to know about doing that planning. And since you're curious enough to know about retirement planning to watch this seminar, you probably have some questions. Questions like, what do you need to know about your pension? Or do you need to do anything? And if so, what? So in order to answer those questions, I have arranged the seminar into a checklist. So I'm going to help you this morning understand retirement basics. And I'm going to help you also understand pension math, the retirement formula, and also we'll talk about purchasing service credit. I'm going to help you get a pension estimate. I'm going to help you understand retirement eligibility. I'm going to help you understand your additional benefits that you might be eligible for in retirement. I'm going to help you designate your beneficiary or beneficiaries and understand career planning options. And I'm going to help you make a retirement planning picture and start a 457B account if you're interested in doing that. And then finally, I'm going to show you how to sign up for Acera News. Okay, so let's jump right in. So the first item on the checklist, understanding retirement basics. Okay, so who is Acera? In one sense, Acera is this acronym for the Alameda County Employees Retirement Association. But it's made up of a lot of people. So there are about 90 of us that work for Acera. And what we do is we provide retirement, disability, and death benefits to all of Acera's members. So that's all of you. And you're an Acera member because of the job that you work in. So you work, or at one point you worked full-time in a retirement eligible position for one of the 6 employers that participates in Acera. So these are the 6 public agencies that are what we call Acera's participating employers that use Acera to provide pension benefits to all of their employees. So that's why you're an Acera member, because of the position that you work in and who you work for. You automatically become an Acera member. And as an Acera member, you contribute to the retirement system. So you are contributing with each paycheck into Acera's fund. A percentage of your paycheck comes out of your check, and I'll show you the next slide what that might look like on your pay stub. Here's the before tax deductions column, and you might see, if you're an Acera member, you will see a before tax deduction coming out of your paycheck with every paycheck and going into Acera's fund. Additionally, every time that happens, your employer makes a contribution to Acera's fund on your behalf. So you're contributing, your employer is contributing, and we take that money and we invest it all over the world in various investments. And we earn a lot of interest on that money. And so it's your contributions, your employer's contributions, and the interest together that give us this big pot of money that is Acera's pension fund. So what do we do with that money? Well, meanwhile, you are earning credit toward retirement by working. So you're working in your job and you're earning credit toward retirement throughout your entire career. And then at some point in the future, you retire. And once you retire, we're going to take that money that we have collected from you and that has earned interest, and we're going to pay you a lifetime monthly retirement allowance. So you're going to get a direct deposit from us every month for the rest of your life. So you cannot outlive your retirement. So that's pretty amazing. And pensions are really special in this regard. That you're going to get that monthly payment every month for the rest of your life, so the money can't run out. And B, everything you paid into the system throughout your entire career, you're going to get all that money back within your first 3 to 5 years of retirement. Everything after that The employer contributions and the investment earnings pay for everything after that. And in fact, the investment earnings pay for about 3/4 of your retirement, your lifetime retirement. So pensions are special. There's nothing else that works this way. Okay, let me show you some pension milestones. So you have the first milestone is your date of hire. So that's the first day that they told you to show up to work. So if you started out in your full-time position, what happens is you have your date of hire, and then 2 weeks goes by, and the first day of your second pay period, that's your first day of Acera membership, what we call your date of Acera entry or your date of entry. If you didn't start out full-time in your position, like maybe you started out part-time, or maybe you started out working under project or working for the county's temporary assignment pool, you didn't become an Acera member until the first day of your second pay period of that full-time retirement eligible position. That's your date of entry into Acera. Okay, so that's the first two milestones. Then what happens is 5 years goes by, and after you work 5 full-time years or the equivalent, you are considered vested in the retirement system. And so that word vesting, that just means guaranteed. So once you're vested in the retirement system, you're guaranteed the vested benefits. You're guaranteed the guaranteed benefits, which is basically that retirement allowance and a couple of other things that I'll show you. So after your vesting date, at some point in the future, you become actually eligible to retire. So there's some requirements that you have to meet, and it has to do with years of service and or your age. And so there's different scenarios that you can meet the eligibility requirements to retire. And I'll show you what those are a little bit later. So after you become eligible, at some point in the future, you choose your retirement date. So it's a date that you decide to retire once you're eligible. Okay, so there are a couple of dates after that. At your retirement date, we start paying you your retirement allowance, and we're going to pay that to you until the time of your death. So your death is one of the milestones on the pension milestone chart. Sorry about that, it can't be helped. But the reason it's on here is because between this date and this date is your retirement, and that is when you're receiving your lifetime pension. And then after your death, a beneficiary that you name at the time of your retirement can actually receive a continuing payment, what we call a continuance, every month for the rest of their life after your death. And so that's also a milestone on here. Okay. So regarding vesting, like I said, it comes once you earn 5 years of service credit, and the vested benefits, the reason that they're guaranteed is they're guaranteed by law. So they're guaranteed by the state law. And the vested benefits are the lifetime monthly retirement allowance, an annual cost of living increase to that allowance, and then a $1,000 lump sum death benefit. And there are also additional death benefits, like I was saying, that continuance that comes along with the retirement allowance, that continuing death benefit. So that's kind of baked in there. Okay, those are the guaranteed benefits. So regarding pension basics, let me show you a few more things. One of them is the tier that you fall into. So all of you fall into a tier. Some of you may fall into 2 tiers if you're a safety member. But you all fall into at least one of these tiers, and it's based on your date of entry into Acera. So if you entered Acera, first of all, let me tell you about the difference between safety members and general members. Safety members are sheriff's deputies, probation officers, and other sworn officers. If you're a safety member, you know it. If you're not a safety member, you're a general member. So if you're a general member and you work for one of our participating employers, you can look at this line right here. If you work for Alameda County Housing Authority or Livermore Area Recreation and Parks District, you're going to want to look at these 2 lines right here to look for the tiers based on date of entry. Okay, so let me just show you how these dates work. So if you entered Acera, if you're a general member, you don't work in these 2 places, and you entered Acera before July 1st, 1983, you would be in Tier 1. If you entered on July 1st, 1983, between that date and then you entered before January 1st, 2013, you would be in Tier 2. If you entered January 1st, 2013 and after, you would be in Tier 4. And the same thing goes for the other employers. So if you entered between these dates, you're in Tier 2 for the Housing Authority. Everyone, for all of the different scenarios here, if you enter January 1st, 2013 and after, you're in Tier 4. Okay, regarding Livermore Area Recreation and Parks District, if you entered before October 1st, 2008, once this date passed, there is a chance that you opted to take Tier 3, so you may actually be in Tier 3 if you opted to do that. For the safety members, you can see the dates of entry here. If you entered October 17, 2010, up to January, basically December 31st, 2012, you had a choice between Tier 2C and Tier 2D. And so that means that you would have made a selection between one of those two tiers, and so your selection would have put you in whichever tier that you're in. Okay, let me read this question that I have real fast. Okay, thanks for that question. The question is, you worked for Contra Costa County for 6 years and you were vested. So going back to the concept of vesting, you worked for Contra Costa County for 6 years and you were vested, and now you switched over to work for Alameda County and you established reciprocity, which means that you linked the retirement systems together. And so the question is, are you vested? Are you considered vested in ACERA? And the answer is yes. So vesting, the 5 years includes reciprocal time. So you're considered vested in all the systems that you have linked together. Okay, and then there's another question about vesting that just came up, which is, if you're vested and you worked in another county, but you missed the reciprocity window, which is you have to start working within 6 months in the new system, but you get vested in the new county too, so you're vested in both. Do you collect a pension from both counties? Yes. So you would, since you're still a member over in the other county and you're vested over there, you can collect a pension once you meet their eligibility requirements. And for ACERA, you can collect a pension once you meet our eligibility requirements, and they would be separate. So you would get a separate check from each, and you could retire on different days from each. For the question I previously answered, since you have reciprocity, you have to retire from the same day from both systems. And we'll talk about reciprocity in more detail toward the end of the presentation. And there's another question: does reciprocity with San Mateo County count towards service years? So let me take that question when we talk about reciprocity in the second half of the presentation. Okay, so we talked about tiers. Okay, then one more thing regarding pension basics. And you'll see this slide again come up later. But I just want to show it to you now just to kind of give you an overarching view of your retirement and your future retirement income. Excuse me. So what financial planners will tell you is that when you go to retire, after retirement, you're going to need 70 to 80% of the income that you were making before retirement in order to maintain your standard of living. And so your income after retirement is going to come through a combination of a few different sources of income. And that can include your ACERA pension, your Social Security income that Social Security is going to pay you, and any other savings and investments that you're going to have. And those would be combined to get you to that 70 or 80%. What we're going to do for right now, for the first half of the presentation and into the second half, is we're going to talk about this one, your ACERA monthly pension. And then we'll touch on these two toward in the second half of the presentation. Okay, just to give you some context for what we're talking about. Okay, moving on to the next item in the checklist, understanding pension math. In retirement, you are going to get, as your retirement pension benefit, also known as your monthly ACERA retirement allowance, you're going to get a percentage of the highest salary that you were making while you were working for each year of service that you worked. So Let me break that down for you a little bit and give you an example of that. So that percentage is this element, this factor in the formula here, age factor percentage. Okay, so let's say that the percent of your salary that you're going to get for each year of service that you work is going to be 2%. And let's say that while you were working, you earned 20 years of service credit by the time that you retired. So you're going to get 2% of your highest salary for each one of those 20 years. So you're going to get 40% of your salary that you were making while you were working. You're going to get 40% of that salary as your retirement allowance. So let's say that your highest salary, your highest monthly salary was $5,000 per month. Just to keep these round numbers. So in retirement, you're going to get 40% of that $5,000. You would get $2,000, and that would be your monthly retirement allowance every month for the rest of your life. So that means that since this is a multiplication, the higher any of the numbers are, the higher the age factor percentage, the higher the years of service credit, the higher your salary before you retire, that equals a higher monthly retirement allowance when we multiply it all out. Okay, let me review this question here real fast. Okay, the question is, let me save that question actually for when we talk about the salary component. The other question, yes, the salaries, so this is gross salary that we're talking about. So it is before taxes. Okay. So let me talk about each one of these factors. Okay, I'll talk about the age factor percentage, then the service credit, then the salary. And I'll answer your question on deferred compensation and the salary once I get to the salary question, the salary factor. Okay, so starting off with the age factor percentage. Okay, so the question is, what percent of your highest salary will you get for each year of service? Because it's not going to be 2%, it's going to be based on your age at retirement. And so to answer that question, what we're going to do is look at this sample age factor chart. So what you're going to do is you're going to find which tier you're in this age factor chart. So we already figured out which tier you're in. It's based on your date of entry into USERRA and whether you're a safety member or a general member. So maybe you're in tier 1, or maybe you're in tier 2 general, or tier 3 or tier 4, or you're a safety member. A lot of safety members who are in their mid-career, actually you could probably fall into any of these tiers if you're in your mid-career or if you're a new employee. And so what you're going to do is you're going to forget about all the other numbers. You're just going to look at the one column that applies to you. So that makes it a little more simple. So I'm just going to pick on the general tier 2 column here because I find that most people are general members in tier 2, just based on a lot of people entered during the time period for tier 2. So one thing that you'll notice, we have the age factors, we have the ages over here. This is your age at retirement, and this is the age factor percentage that you're going to get in the formula for you. So if you retired at age 60, for example, and you were a general member in tier 2, when you go to retire, we're going to come over to the chart, we're going to go down to age 60, we're going to come over to tier 2, we're going to see 1.92%, and that's the age factor percentage we're going to use in the formula for you. So you're going to get 1.92% of your highest salary for each year of service credit that you work. You'll notice that the age factor percentages get larger the older you are when you retire. So the longer you wait to retire, the older you are, the higher the age factor percentage you're going to get, up to the highest age factor percentage for your tier, which is represented by the blue boxes. So the highest age factor percentage for general tier 2 members is 2.43%, and that's at age 65. If you retire older than the highest age factor percentage for your tier, you're just going to get whatever the highest age factor percentage is. So if you retired at 66 or 67 or 77 for general tier 2, you would still get 2.43%. One thing that you'll probably notice about this chart is I skipped a bunch of the ages here, and that's because there are so many age factor percentages that they don't all fit on the slide because they actually increase with every quarter year that you wait to retire, and it's based on your birthday. So if your birthday is January 15th, for example, and you're age 50 and you're thinking about whether you're going to retire or not, if you waited 3 months past April 15th, you would go up one notch in the age factor chart. If you passed July 15th, you would go up another notch in the age factor chart. October 15th, and back to your birthday of January 15th in this example. And so every time you pass one of those days and you don't retire yet, you go up one notch in this chart and you get a slightly higher age factor percentage. So if this were the full chart, it would say 50, 50 and a quarter, 50 and a half, 50 and 3/4, 51, and so on and so forth. And there's a slightly higher age factor percentage for each one of those. So if you want to see what all those percentages are, one thing that you can do is search for age or age factors on our website, or you can type in estimator.org/age, and there's a PDF in there that shows you all the age factor percentages for all the quarter year increments. Okay, let me see what this question is. Okay, so the question is, does collecting Social Security reduce your pension? No, it doesn't. So we're going to pay you whatever the pension is that you earn, regardless of how much you're going to be collecting from Social Security. I haven't heard that Social Security would reduce what they're paying you based on you having a pension. That would be something to explore on the Social Security website, but I don't think that's the case. Okay. So just one more thing about the age factor percentages. The bottom line with that is that an older retirement age basically equals a higher age factor percentage up to the max for your tier. So the older you are when you retire, you get a higher and higher age factor percentage. Okay, so we talked about the age factor percentages. Let's talk about the service credit. So service credit is measured in years, and you start earning service credit when you enter SARA. So on your date of entry, that's the time that you start earning service credit. And you're going to earn service credit all the way up to your retirement date. Or if you stop working before you retire and defer your retirement to a later date, you would earn service credit all the way up to that date, what we call your termination date, or the day that you quit your job. So you earn service credit during your regular work hours. So while you work, you earn service credit. You also earn service credit while you're out on your earned vacation, your earned sick leave, management leave, comp time, if you've earned comp time, holidays and floating holidays. Taking those types of leave does not count against you for service credit. You're already earning service credit during those times. Okay, now there are some times when you don't earn service credit. If you're ever on leave without pay, you're not earning service credit. If you purchase additional vacation, that is in addition to your earned vacation, while you're out on that purchased vacation, you're not earning service credit. If you sell vacation, that does not give you more service credit. If you sell vacation during your last few years, like your period of highest pay, that could increase your salary, but it doesn't increase your service credit. But you do, whenever you sell vacation, you do get the cash for the vacation that you sell. And you don't earn service credit during overtime, on-call time, or standby time. Okay, so there are some types of time that you may have out there that are eligible for you to make a service credit purchase. So you're basically purchasing this time as a SARA service credit. So those include what we call ineligible time. It's basically time where you perhaps could have earned service credit if the situation was slightly different, but you didn't. And those times include any part-time work that you didn't already earn service credit for. So if you started out part-time and then you went up to your full-time retirement eligible position, that part-time work is purchasable as long as it's not for employment agency, you weren't a temp, you weren't under contract, things like that. That's not purchasable. But if you're just plain old part-time, that's purchasable. Or if you worked for the county's temporary assignment pool, or you worked seasonal, intermittent services needed, you worked project or per diem work, it's what we call what was ineligible employment time, and that time is purchasable. Then we have the days between your hire date and your entry date. So that's that 2 weeks between the first day of your full-time retirement eligible position and this first day of the second pay period. Those 2 weeks, that is purchasable. If you ever go out on unpaid medical leave during your career, when you return from that leave, that's purchasable up to 1 year per leave, per instance. The same thing with state disability insurance leave. Also, workers' comp time. With that, sometimes the state disability system is paying you partially and your employer is paying you partially. And so you're earning service credit for the time that your employer is paying you. So that other portion, that is the state disability insurance leave or the workers' comp time, that portion is purchasable. If you go out on military leave during your membership, you can buy that when you return. If you're redepositing a prior membership, like you used to be an Estimator member in the past, and you took a refund of your contributions and now you're back, and you want to redeposit that money to get your service credit back, that's called a redeposit, and that is considered a service credit purchase. Also, redeposit of community property. If you got divorced or you dissolved your domestic partnership and a part of your service credit and contributions went to your ex-spouse or ex-partner, and if they take a refund, then you can purchase that time. It's called a redeposit of community property to get your service credit back. And then finally, there's this time right here, which is if you used to work for a different public agency in California and you're not eligible for their pension, maybe because you didn't work there for very long, or maybe because you took a refund of your contributions from their pension, you can buy that time as a SARA service credit. So like if you worked for East Bay Mud for a year, if you take a refund of your contributions over there, you can buy that year as a SARA service credit. Intermittent, so let me take a few questions. Intermittent time in another county, I don't think that is purchasable. Okay, let's see. Okay, let me take that question about taking a lower paying job later when I talk about salary. Okay, so the question is, if we missed the opportunity to purchase the days between the date of hire and the date of entry, can we purchase it at a later date? And the second part of the question is, why does it cost more now? So let me take the first part of the question first. So there's this thing that is called declaring your intent to purchase, and it counts for this time and this time. So you had 1 year after your date of hire to declare your intent to purchase these two types of time. You may have declared it because we try to get you to do that on your member enrollment questionnaire. If you started working before we instituted this rule, we had given everyone a year after we instituted it to go ahead and declare their intent. So you likely already declared your intent to purchase. If you don't remember, you can give us a call and ask if you did that, if we have that on file for you. And if you did that, then this is purchasable at any time before retirement. Okay, so yes, you can purchase it. All of these types of time, you can purchase them. The cutoff is your retirement, so you have to finish paying for them before you retire. Regarding why does it cost more now, let me talk about let me take that when I talk about the cost of purchasing service credit. So some types of time are not eligible for purchase, which we commonly get asked about. Vacation purchase time, you can't purchase that. You didn't earn service credit for it and it's not purchasable. Also, non-medical leave without pay, contract or temp agency time, or other prior public service for other agencies where you still have your contributions on deposit with their pension system, you got to take a refund before you can purchase the time with the SARA. So you got to refund your contributions from the other pension system before you can purchase that as a SARA service credit. Okay, so regarding the question about why does it cost more to purchase service credit now than when you looked at it in the past? Or how much does it cost to purchase service credit? What it's going to cost you if you want to make one of these service credit purchases is whatever your employee contributions had been had you worked that time in the past. So let's say that you're trying to purchase 6 months of unpaid medical leave from 5 years ago. Okay, so had you been at your job working during that 6 months, you would have been earning your pay and you would have been contributing a portion of your pay into a SARA's retirement fund during that 6 month period. Okay, so whatever that would have been based on your rate of pay back at that time and based on your contribution rate back at that time, that is what it's going to cost you to make that service credit purchase. Plus, you're going to have to pay interest on that money because had you made that service credit purchase back at that time, or I'm sorry, had you earned the service credit back at that time and made those contributions back at that time, that money would have been in a SARA's fund earning interest. We would have invested it and it would have earned interest. And so you're going to have to pay the interest that that money would have earned between the time that you're trying to buy and now. So if you're trying in this example to buy 6 months of unpaid medical leave from 5 years ago, that's 5 years worth of interest that you're going to have to pay because that money would have earned interest over that 5 year period. So that's why the longer you wait to purchase service credit, the more expensive it gets because the interest keeps accruing and accruing and accruing. Okay. So let's see. So regarding the question, does reciprocity with another county count towards service credit? It doesn't count toward your service credit here. So let's say that you worked 5 years over in Contra Costa County and then you work 5 years over here. It doesn't count toward your service credit here, but it counts. But if you have reciprocity, it counts for your service credit over in Contra Costa County. So when you go to retire, we're both going to do a retirement calculation, which is they're going to do their calculation with your 5 years over there. We're going to do our calculation with your 5 years or whatever you earn over here, and then we'll both send you a check. So when you're thinking about the retirement formula and how much of your service credit is going to go into our formula, it's only the time that you earn here. Okay, there's a question. Do you earn service credit if you're out on Family Medical Leave Act? So the Family Medical Leave Act, that is a federal law that says that you basically you are able to retain your position through long periods of medical leave. So if you are out on leave and it's considered FMLA, Family Medical Leave Act time, you might be using your sick leave balances. And if you're using your sick leave balances, you're already earning service credit during that time. Okay, let's say that sick leave runs out and you decide to use your other balances, like your vacation leave. Well, you're already earning service during that time, so that's that doesn't you've already earned that service. Now, if you run out of your leave balances and you're just out on what we call unpaid medical leave, and that could also and it can be under the umbrella of Family Medical Leave Act time, then you're not earning service credit for that unpaid medical leave time. So when you return from that leave and go back to work, then that's the portion of that time that's purchasable. Okay. Okay, there's a question about you left the county for 6 months to work for the union. Can you claim that time? I'm pretty sure you can't because that's not a government agency. So that would not be purchasable and that would not be considered another agency. I'm like 99% sure, but that would be a good question to send into you could email that through our contact page and one of our retirement specialists could answer that question definitively. Okay, and I had answered the San Mateo question. Okay, let's see. Okay, so the question is, if you worked for a temp agency that had you working at the county prior to that time, can you purchase that time toward vesting? That is generally, I've never heard of that being purchasable. What they tell us is that if you're working for an employment agency, you were an employee of that employment agency and not really of the county, and so that's not purchasable time. Okay, this is a question regarding reciprocity and age of entry. So if you have reciprocity, is your age of entry into a SARA what it was in the first retirement system that you have linked together? Yes. So that would be what the date that we would look at when we're considering what tier you're in for a SARA, and that would be considered your date of entry. And so I have a question: what is the limit to the benefit payment for tier two? I'm not sure I understand the question. Um, the limit on the age factor percentage is 2.43% at age 65, but beyond that, your retirement can go up and up and up. If you earn more service credit and you get higher salary, your retirement allowance amount would go up. Um, I do have a slide on benefit payment limits a little bit later. Maybe I'll address that also when I get to that slide. Okay. Okay. So I just have two more outstanding questions, and they're both about the salary component. Okay, so that's how much it's going to cost to purchase service credit. Now, if you want to make a service credit purchase, what you do is you submit a purchase redeposit request on, you log into your account and submit one of those requests. We will do calculations and send you a letter with the cost and whether or not the time is purchasable. And then you can decide if and how much of, if you want to make the purchase and how much of the purchase you want to make. Now, for all of the types of time except for the redeposits, you could buy a portion of it. The redeposits, yeah, it's all or none. Also, regarding the cost, for all of these types of time, since the employer is an ACERA employer, you're just paying the employee contribution and interest to make the purchase. For this time, since the employer is somebody else, you're going to have to pay the employee portion and the employer portion. And so this one can cost double or triple of what the other ones can cost. And so there's a question: you went full time this year and bought back 7 years of service. Okay, so it sounds like you entered a SARA this year. You got your full time retirement eligible position, and then you bought 7 years of previous service immediately, which is the great thing to do because you paid not very much interest on that, or maybe no interest. If you return back to part time, will you still earn money toward your pension as a part time employee? Yes. So that's the good thing about achieving the full-time retirement eligible status. That puts you into SARA, and then you can go back to part-time. What happens if you go back to part-time is you will earn service credit at a slower rate. So if, like, you worked half-time, then for every 2 years you work, you would earn 1 year of full-time service credit, basically. So you earn it at a slower rate. Going down to part-time doesn't count against you regarding the salary component. And let me talk, I think I have another outstanding question about that. So let me talk about that when I get to the salary component. Also, taking a lower paying job is the question. Okay, and let me take that other question in just a minute. Let me get to the end of this service credit purchase thing. Okay, so now if you want to make a service credit purchase and you decide that you want to, you will have these payment options. So you could write us a lump sum check and pay on a post-tax basis. You can roll over pre-tax funds from another eligible type of retirement account. You can do payroll deduction payments to split up the payments over time, and that's on a post-tax basis, or you can do any combination of those. So if you don't quite have enough money to pay out a lump sum and from a rollover, then you can split up the rest over payroll deductions. Okay, so I often get this question, how do I figure out whether purchasing the service credit is worth it, or is it worth it? So what you do to figure this out, you can figure this out for yourself, is you log into your account at acera.org. So you can press the account login button at acera.org, or you can just go to acera.org/WMS, which stands for Web Member Services. That's our member portal for you. So you log in there and you log into your account. And then once you're in there, you're going to see a benefit estimator. And I'll show you some screenshots from that a little bit later. And once you do get into the benefit estimator, you're going to run two estimates. You're going to run one estimate for some retirement date in the future. So you're going to pick a scenario, and actually for both estimates, it's going to be the same retirement date because you're kind of doing the same scenario for both estimates. So you have some retirement date in the future. Let's say it's like 10 years from now. So you pick just some date in the future for this scenario, 10 years from now. Okay, there's a field in there where you can override your amount of service credit. So you can pick a new service credit number for yourself. You don't do that for the first estimate. You just run it normal, and then it tells you how much you're going to get for your retirement allowance in estimate number 1. Then you run estimate number 2. You do it for the same retirement date. So you're doing the same scenario, except in this scenario, you're going to use that service credit override field to increase your amount of service credit by the amount that you're trying to purchase. So if the service credit in this scenario, this retirement date scenario, you would have earned 20 years of service credit and you're trying to purchase 3 months of unpaid medical leave, that's a quarter year. And so you would put 20.25 in the override field, and then you run estimate number 2. Your retirement allowance is going to be bigger in estimate number 2 because you have more service credit in there. So then what you do is you subtract those 2 retirement allowance estimates to see what the difference is between them. Because estimate, like I said, estimate number 2 is going to be bigger than estimate number 1, so you see what the difference is. This is the amount of retirement allowance increase you're going to get because you made the service credit purchase on a monthly basis. That's the increase on a monthly basis. So then what you do is you take the purchase cost that we tell you in that letter that is going to cost you to make the service credit purchase, and you simply divide by this difference between the 2 estimates. So you're taking the amount that of money you're going to have to put down, and you're going to divide by how much the increase is going to be for you, how much that service credit purchase is going to get you, and that's going to tell you how many months it's going to take to get your money back. Because eventually in the future, you are going to get your money back from making that service credit purchase because your retirement allowance goes up. But for what you're going to weigh is whether it's worth it on how many months it takes to get that back. So you can even take that number and divide it by 12 to get the number of years that it's going to take you to get your money back. If it takes you a year, 3 years in increased retirement allowance payments to get your purchase cost back, that sounds pretty worth it. That might be worth it for you. If it's going to take 20, 25, 30 years to get all that money back, maybe that's not so worth it for you. So you just run those estimates, and that's how you decide whether purchasing service credit is worth it. Okay, let me see if I have another question about service credit before I move on to the salary component. Okay, so the question is, how do I know if I'm eligible to buy the service credit, and how much am I allowed to purchase? So you know that you're eligible to buy the service credit if you know that you have one of these types of time. Okay, so you did this ineligible work, or everyone has these days, these 2 weeks between your date of hire and your date of entry. Or maybe somewhere in your career you went out on unpaid medical leave time, or state disability insurance leave time, or military leave, or you know that you can make one of these redeposits, like you know you have this type of time. If you know you have this type of time, then you submit the service credit purchase request, and we will tell you how much it's going to cost. If you have a type of time that you're not sure whether it's purchasable or not, you can go ahead and submit the request, and we'll tell you whether it's purchasable or not. So you can just go ahead and do that. I will tell you that you can't just purchase airtime, what they call airtime, which is like, I want to purchase an additional year of service credit, even though I don't have any of these types of time. That's not permitted under the law. So that's how you know whether it's eligible, is you just go ahead and submit the service credit purchase request. Okay. Okay, so regarding, let me get back to where I was at. So regarding this question, once 20 years of service credit are reached, yes, you're correct that you will have achieved the maximum medical benefit, which is an extra benefit that I'll tell you about in the second half of the presentation. You will have achieved the maximum medical benefits that you can get, and the question is, are there any other changes to the pension calculations if you earn more than 20 years? And a sub-question of that is, do contributions stop after 20 years? No, contributions never stop. You as an employee are paying into the system throughout your entire career, and your employer is also contributing on your behalf throughout your entire career. So those don't stop. Regarding the question of, are there other changes in the pension calculations? Yes, because even though you've achieved 20 years of service credit, if you work past 20 years, you're going to continue earning more and more service credit. So some people work 30 years, 40 years, and you would get all of that service credit in the calculation for you. Your service credit is actually calculated down to the fraction of a day. So if you see your service credit number, it's not a round number like 20 or 21. It'll say, if you've worked 20 plus years, it'll say like 20.786527. All those decimal places are calculating it down to the fraction of a year, and you get all of the service credit in the formula for you. So you're earning service credit from the moment you enter Acera all the way up until the time that you stop working. And you'll get all of that service credit in the formula for you. And so if you work for 30 years, you'll have 30 years of service credit in here. So earning service credit doesn't stop at 20 years. Additionally, the longer you work, you're going to earn higher and higher salaries. And so this number is probably going to go up as well. So that's going to get you more retirement allowance. Plus, if you're getting older and older and older, the age factor percentage is going to keep going up too, until you reach the maximum age factor percentage for your tier. So just working 20 years, I mean, you're going to keep earning more credit in potentially all three of these categories if you keep working. And that's going to make your retirement allowance go up. The question is, you worked for a state agency in Virginia in the 90s. Is that eligible for service credit purchase? It's not, because it's only, the other prior public service is only California, agencies within the state of California. So sorry about that. But if you still have money over there, and it was in Virginia that you were asking about, you may be eligible for their pension system, for a pension from their pension system. So you may want to give them a call or check their website and see if you will be eligible to collect a pension from them one day. And the question is, do the employer's contributions to the pension change after 20 years? The employer's the contribution rates are set based on how much money the fund needs to pay the retirement allowances that we owe now and in the future. So there's nothing about hitting an amount of service credit that changes the employee or the employer's contribution. There is one exception to that for the safety members in, I think, Tier 2D. After you get vested, your employee contribution goes down a little bit, but for everyone else, our actuary calculates how much money we're going to need to pay out benefits, and that's how the contribution rates are set. Okay, so the question, and this is still regarding service credit, is that you left San Mateo County after 5 years of service and got reciprocity when you left them and started working for Alameda County. So now you've been with Alameda County for 8 years, over 8 years. The question is, can you roll over the value of your retirement account and the service credit from San Mateo and add it to your balance with Alameda County? And the answer is no. And the sub answer to that is you don't want to do that. And you don't, there's not a good reason to do that. Let me address why you don't want to do that when I start talking about reciprocity, because you would lose the advantages of reciprocity if you were going to do that. So let me hang on to that, and I'll talk about that when I get to reciprocity. Okay, let me talk about the salary component of the formula. So when you go to retire, what we're going to need to do is calculate what your highest average monthly salary is during your career. And what we're going to do to be able to make that calculation is we're going to find what we call your final compensation period, which is your period of highest pay, your consecutive period of highest pay during your career. So if you're in Tier 1 and Tier 3, that is your highest 26 biweekly or 12 monthly pay periods, depending on if you're paid biweekly or monthly. And if you're in Tiers 2 and 4, it's your highest consecutive 78 biweekly or 36 monthly pay periods. So essentially, for Tier 1 and Tier 3, it's your highest year of pay. And for Tiers 2 and Tier 4, it's your highest 3 years of pay that we're looking at. And that's what we call your final compensation period. Now, what we do, the calculation that we do to figure out what the average is over that time, is we simply divide the total amount of pay you made during that final compensation period by the amount of months in the period. So for Tier 1, we're dividing by 12 months. For Tier 3, we're dividing by 36 months. And that tells us what the average pay is that you made over that final compensation period, that full highest period of consecutive pay. So what types of pay go into the calculation? So if you are paid, so the types of pay that you're paid during your final compensation period that would go into this highest average salary calculation include your base pay, of course, because that's your normal pay. And for all these types of pay, we're talking about gross pay. So this is your pay before any deductions are taken out. So regarding the question about does deferred compensation impact your highest average salary, does it bring that number down? No, it doesn't. Because we're looking at your pay before any of those deductions are taken out. So this is gross pay. So we're looking at your base pay is going to go in there. And then also there are some other types of pay that can go in there that are sometimes known as footnotes or other pay codes. These are other types of pay that are based on skills and education. And I can't tell you off the top of my head whether your pay code is in or out of this equation, because there are like 1,000 different pay codes. So to figure this out for yourself, what you do is you go to this page on our site, estimator.org/paycodes, or you can just search for pay codes on our site. Excuse me. And you would, once you go to that page, you look for the PDF for your employer and you open that PDF. So if you work at the county, you would open the Alameda County one. And then there's a list of pay codes, and they're by description and by number. And you find your pay code, and it'll say yes or no whether it's in or out of this equation. And so that's how you figure that out. If you don't know what your type of pay is called or the number, you can ask your payroll manager for more information. One type of pay I can tell you that never counts is overtime. Overtime never counts. And then for tiers 1, 2, and 3, I don't think for tier 3 actually currently, because you're not allowed to sell vacation. But for tiers 1 and 2, if you sell vacation during that period of highest pay, that final compensation period, or your final compensation period is at the end of your career, and you cash out vacation at that time, you still have vacation left over in the books, so they compensate you for your unused vacation at that time. If that pay, since that pay is coming during that final compensation period, that's going to increase your total pay during the final compensation period, and it's going to increase your highest average salary. So that will increase your retirement allowance as well. So that will be included in here. And I'm not going to go into detail on that because that is something that we do in our pre-retirement seminar. So you can attend that seminar if you want an explanation of that. We also have an explanation out on our website of how that works. And so just really quickly, just to clarify these two regarding the question I just got, the difference between these two is vacation sales are you selling your vacation while you're still employed. So if you go to your payroll clerk like this afternoon and you say, I want to sell some vacation, and then they would let you sell it, then that's selling vacation. Cashing out is that you haven't used all your vacation by the time you stop working and or retire, and so you simply have it left over on the books. And so they cash you out for your vacation at that time. Okay. So there was a question over here regarding pay. There were actually a couple of questions. So one is, if you take lower pay during the last years of service, will that lower your pension? And then a kind of similar but separate question to that I'll also address is, if you work less hours, will that affect your pension? And in both cases, it won't, because going back to the final compensation period slide, if you take a lower paying job at the end of your career, what we have to do to make this calculation is we have to find your highest consecutive pay periods that you achieved at any point in your career. We're looking for your absolute highest pay during your entire career, your highest 78 biweekly or 36 monthly pay periods. So if you take that lower paying job at the end of your career, that's going to shift what your final compensation period is going to be to earlier in your career. So we're just going to go back in time. We're going to take those highest pay periods, and that's going to be your final compensation period. So in that sense, it doesn't affect your pension, because whatever your highest pay you achieved, that's what we're going to use in the calculation for you. Okay, now regarding the question of if you go back down to part-time, let's say that you do that at the end of your career or at any time, that also does not affect what your highest average salary calculation is, because what we're going to do in this calculation is we're going to look for the highest 3 years of pay or the equivalent of the highest full-time 3 years of pay. So let's say that your last 6 years, if you're in tier 2 or tier 4, your last 6 years of work, you decide that you can't work full-time, you're going to go down to work half-time. Well, that's the equivalent of 3 full-time years. So what we're going to do, since you're making your highest rate of pay at the end of your career in this example, but we don't have 3 full-time years of pay, we're going to smash those 6 years of half-time pay together to get the equivalent of 3 full-time years of pay. So that's how we would do that calculation for you. Okay, and then regarding sick leave day, the sick leave day question, do sick leave days get added on a 1-to-1 ratio? I don't know if I skipped over that or if I had taken that out of this presentation, but you're going to get, if you go straight into retirement, you're going to get service credit for your sick leave days on a 2-to-1 basis. So you're going to basically get half of your unused sick leave as service credit, up to a cap, up to a limit. And the limit is based on your MOU, your Memorandum of Understanding for your position. A lot of the caps are 125 days of sick leave, which means you would get 62.5 days of service credit if you're getting half of your sick leave as service credit, which is about 3 months more of service credit. And that's if you go straight into retirement. If you don't go straight into retirement, which means you stop working and defer your retirement, you just lose all your sick leave. And then the second part of your question is, does a sick leave day count as much toward retirement as a regular workday or regular vacation day? So yes, if you actually use a sick leave day, you're out on sick leave for a day, that counts the exact same as a work day or a vacation day or a floating holiday or a holiday, all the other types of leave. So those count the same. Okay, so regarding limits to benefit payments, there was a question about this earlier that kind of alluded to this earlier. One limit for Tier 4 members, if there's any of you here watching this, is that The law tells us that we have to cap the amount of salary that we can include in the salary calculation for you, the amount of annual salary. The number is given in an annual number. So for general members, it currently is $126,000 and $126,291. For safety members, it's $151,000, $549. And so, so if you were, let's say that you were a general member and you made $150,000 for your last 3 years of work, for your final compensation period time, we would have to cap that annual amount down to this dollar amount per year. So you would have made a total amount of money that is available for this calculation, like 3 years worth of this cap. That's the bad news. The good news is that while you are working, if you hit this cap, we don't take any employee contributions for the amount of salary that you make over the cap. And so you can use what would have been contributed to the retirement system to put in your deferred compensation account or your investments to save additional money for retirement. That's just unique to Tier 4. For Tier 2 members, this cap doesn't exist. There's more caps that you can read about if you go to this page on our site, estimator.org/limits. One thing that I'll tell you right off the bat is you can't make the main one that people might hit is you can't make more than 100% of your final average salary in retirement. So whatever we calculate your final average salary to be, you can't make more than 100% of that in retirement. So basically, it's preventing you from making more in retirement than you were making while you were working. But most people don't hit that limit. For Tier 2 members, you have to work over 40 years to hit that limit. For Tier 1 members, you have to work over, I think 35 years maybe, and it all depends on your age also. For safety members, it's like 30 some years, and also depends on your age. You have to be much older. So most people don't hit that limit. There's also some limits for people who have really high salaries, like over $250,000 a year, and so you can check that out. But the vast majority of people do not hit the limits to the benefit payments. Okay, and this is the whole thing put together. So this example is a Tier 4 member who retires at age 65 after working for 25 years. And so their age factor percentage based on their age of 65 and based on their Tier 4 is going to be 2.30%. We're multiplying that by their 25 years of service. They earned exactly 25 years of service in this example. And then they were earning their highest average monthly salary was $6,000 a year, and that gives them a $3,450 monthly retirement allowance, which works out to be 57.5% salary replacement. So you can see that if you multiply the age factor percentage times the years of service, that gives you the salary replacement number. And remember, back to that first slide that we saw in the beginning of the presentation, you are trying to achieve 70 to 80% salary replacement in order to maintain your standard of living. So your pension, in a lot of cases, is only going to get you part the way there. So later on, I'll tell you how to fill in that gap. Okay, let's talk about getting a pension estimate for you. I'm going to show you a couple of ways to do this. One is the super quick way, and it's by using these salary replacement charts on our website. So you can go to estimator.org/getestimate, or you can navigate out to our site and search for these. Let me just switch my sharing over, and I can show you how those work real fast. Okay, let me know if you can't see web page that I'm showing you. So this is our get an estimate page. This might look a little bit different in the future because we're about to relaunch our website. If it looks a little bit different, you can just search in the search blank for income replacement. So it's these charts here. And the way these work, I'll click on the general tier 2 chart, is you see all of the different ages at retirement that you might retire, and then the different years of service credit, and you just find where they intersect. So if you're going to retire at age 60 with 20 years of service credit, you come over here, and in that scenario, you would get 38% of your salary that in retirement. So you're basically getting 38% income replacement. So we basically what the chart is we've multiplied out the age factor percentage times the years of service credit for you, just so you can really quickly get an idea of how the income replacement increases as you move up in age and as you move up in years of service credit. So that's how that works. So let me switch the screen sharing back over to the presentation. And let me know if you can't see the presentation. Okay. So that's the first way to get a very quick estimate. The next way, it doesn't take that much longer. It may take you 5 minutes if you've already done it before. So you go to our website, you press the account login button. You're going to end up inside what we call Web Member Services, which is our employee member portal. And this has all your pension data in it. This is your account with the SARA. This is your personal account. The first thing that you're going to see is this account summary page, and you can see the summary information that we have for you, the amount of service credit that you've earned, and if you've made service credit purchases, you can see that in there, and the contributions that you've contributed. Now, what you're going to do is you're going to click this Estimate a Benefit link to go to the Benefit Estimator. So you're going to do a retirement scenario in this Estimated Benefit screen. So you're going to say, okay, I want to see what happens if I'm retiring 5 years from now, or if I retire 10 years from now, or 15 years from now. And so you just pick a set of dates that kind of match the scenario that you are that you're thinking about, that you want to know, that you want to get an estimate for. You have to put in 2 dates. The first date is projected retirement date. So this is your first date of retirement. The other date is separation date, which is your last day of work or last day in active pay status. If you're going to work right and go straight into retirement, then the projected retirement date would be just the next day after the separation date. So you would just pick the next day. If you're going to stop working earlier and then retire later, you can do that scenario here as well. Like you're going to stop working in a year but not retire for 5 years, then you can put that scenario in here as well. Then you hit calculate. I'm going to zoom in here. So I put in a couple of dates in the screenshot and then hit calculate, and it will project the amount of service credit that you will have earned in this scenario. And then it will also give you a salary projection for this scenario. You have the opportunity to override both of those numbers in the service credit override field, which I referred to a little bit earlier when I was talking about figuring out whether service credit purchases are worth it or not. And you also have the opportunity to override your salary amount. So if you're going to retire 10 years from now, there's a good chance that your salary is at least going to be higher by cost of living increases that you might get. And so you could just try to multiply your salary by inflation every year for 10 years and then put that higher number in there to see what the effect of that would be. Or if you want a nice conservative estimate, you could just leave the numbers alone. And then you can put in beneficiary information here, and then you hit get an estimate or get estimate, and you end up with this PDF, which is your ACERA benefit estimate for this scenario that you're doing. So if I zoom in here just on the data in here, you'll see that it has information up here on how it's calculating the estimate, which is down here. So it's giving you the date range that it's using to you make the salary projection, and it's got the service credit here. It's got your entry date here, your age at retirement, and then what the number that you're going to be looking for is this number right here, which is your retirement estimate. This is the estimated amount that you would get per month for your lifetime retirement allowance at the time of retirement for the rest of your life, plus cost of living adjustments. The reason I'm only circling this box right here is because you will have the opportunity there you can delve into what the different options mean in our website. This one pays the most retirement allowance to you. The unmodified option pays the most retirement allowance to you as the retiree, and this is the one that the vast majority of people select. So if you want just kind of a plain old estimate, you can just look at this number right here. Okay, so that's two ways to get a estimated projection of your retirement allowance or a pension estimate. Okay. Let me help you understand. Oh, there's a question here. Okay, the question is, on the estimated monthly benefits, is the estimated monthly allowance in today's dollar value or future dollar value? Let's see. It's in today's dollar value, but it will be the dollar amount that you get in the future. So going back to the estimator, the way that this salary projection is working is that it's using your data that it has in the system for you right now. So that's today's dollars. And so if you're, the example I gave is you are doing an estimate for 10 years, you're going to retire 10 years from now. Well, since it doesn't have salary for you for your future final compensation period, which will likely be your last 3 years of work, 10 years from now, then what it's going to do is it's going to take your last pay period that it has on file for you, and it's going to fill in that 3 years worth. If you're in tier 2, if you're in tier 1 or tier 3, it'll be the 1 year's worth. But if you're in tier 2 or tier 4, it'll fill in that 3 years worth of pay periods with just this last pay period. And then so that's how it gets a total, and then it takes an average of that. And that's how it's getting this final average monthly salary. So that's in today's dollars. And then it's doing the calculation based on your age factor percentage in the future and your service credit in the future, but using this dollar amount. And so that's what would happen in the future if this were the dollar amount that it was going to use. But like I said earlier, this is probably not going to be a correct dollar amount if you're doing a projection for 10 years from now, because you're going to get raises and cost of living increases. So if you want to see what the effect of that would be, that's when you would use the salary override blank. Okay, so there's also a question, if you're now remarried and you have previously had a dissolved domestic partnership, and let's say or marriage, at the time of retirement, will that ex-domestic partner or spouse be contacted for any portion of benefits? Maybe. And it depends on how that divorce or domestic partnership dissolution was conducted, and like how the community property was divided. So if you are married or you're in a state registered domestic partnership, and we're talking about state registered domestic partnerships, not just domestic partners. When you get divorced or you dissolve that state registered domestic partnership, any retirement that you earned while you were in that marriage or while you were in that state registered domestic partnership is considered community property that's out on the table for division when um, when it comes time to divide the assets. So you're always dividing the community property up between the two of you. And so if you had negotiated that part of your Acera account would be divided off and given to your ex-spouse or domestic or state registered domestic partner, then they would have gotten, your account would have been divided, and they would have gotten part of your service credit and part of your retirement contributions. And then over here, you're retaining service credit and contributions, and then you're continuing to work, so you're continuing to earn service credit and pay contributions into the system. And so you have your separate account over here that you retire from, and then over here they retire separately, and so you don't really know what the other one does, unless the other one decides, rather than retire from Acera, they're going to take a refund of the contributions. So basically they're canceling their account. We will notify you if that happens, and you will have the opportunity to buy that, redeposit that money, and get your service credit back. Okay, so that's one scenario. Second scenario is that if in the community property division there was no division of the Acera assets, then you would just retain your entire account. So maybe you negotiated away a different piece of community property for being able to retain your Acera account, then it's retained. If division of your Acera account isn't addressed in the community property settlement, I don't really know the answer to that question, but that would be a question for our legal department. So you would want to call our number and ask for the legal department, and they can answer that question for you. And then the last scenario is that maybe in the settlement, in the community property division, it says that we don't divide the community property, but we divide the check when you retire. We can do that as well. So we can either divide the account into two separate accounts, or we can keep the account whole and just divide the check. So it all depends on what it says in that judgment. And so what we need from you, if you have a divorce or a domestic partnership dissolution, is we need a copy of the divorce decree that says how to divide the community property. And we need that in any case, whether or not it says there's a division of community property or not. So if you got divorced or you have a domestic partnership that is dissolved, and you were married or you had that domestic partnership during the time of your Acera membership, we're going to need all that paperwork. If you don't send that paperwork to us and we don't know that you were divorced or you had a domestic partnership that was dissolved, we'll start paying you your retirement allowance. But then what's probably going to happen is, once there's money on the table, that ex-spouse or domestic partner will show up and say, oh, I thought I was supposed to get a portion of this, and so we're going to have to put your retirement payments on hold while we figure out how to divide it. So it's just best to send in all that paperwork, and then we can help you with it. And our legal department, that's about the extent of my knowledge on this. Our legal department can help you answer any more questions on how divorce affects your Acera benefits. They can't help you negotiate your community property division, though. That's something that you're going to have to pay a divorce attorney $35 every 6 minutes to be able to help you negotiate. But our legal department can answer questions on how divorce or domestic partnership dissolution affects your community property. And the question is there something an ex-spouse can fill out to forego receiving any of the community property of the retirement ahead of time to avoid issues? And that would be addressed in the community property settlement. So that would be like if they so you would have negotiated that during the community property division, and it would say that you're retaining your Acera retirement. If that didn't happen, that would be a question for our legal department. So you would want to call in to our main number and ask for our legal department for help with that question. Let's see. There's two questions up. What happens if you die before you retire? What happens to your pension? And can you take a lump sum retirement payout? I'll answer those questions. I have slides on those later. Okay, so moving ahead to understanding your retirement eligibility. Okay, so we're talking about this milestone right here. When you become eligible to retire. For tiers 1, 2, and 3, once you meet one of these three scenarios, then you are eligible to retire. You're considered eligible. So your first option to meet eligibility for retirement is you have to be age 50 and have at least 5 years of service credit and have at least 10 total years of membership, which means at least 10 years has to have passed between your date of ACERA entry and when the time is you're trying to retire. I'm not sure why this additional rule exists, but that's the rule in the books. The reason that there's a difference here is because you can work 5 years and stop working after you've achieved 5 years of employment, and be over age 50, and you're not eligible to retire yet until you've achieved that 10 years of membership. So you'd have to let another 5 years go by, and then you could retire. Now, most people will just work straight into retirement. So in that case, you just want to think about it as working 10 years and being over age 50, and then you can retire. Okay, option number 2, you can be any age and retire with a certain amount of service credit. So 30 years as a general member and 20 years as a safety member. You're going to retire at any age. So you can retire under age 50. Or option number 3 is that you can be age 70 and retire with any amount of service credit, even if it's under the 5 years. Okay, so that's tiers 1, 2, and 3. Tier 4, your eligibility options are these two. So option number 1 is that you are a general member age 52 or a safety member age 50 and above, and you have 5 years of service credit, you're eligible to retire. So you don't have to do that 10 years of membership thing. And then option number 2 is you're age 70 and you can retire with any amount of service credit. So once you meet these eligibility requirements, that's how you reach that pension milestone of retirement eligibility. And then you can choose a retirement date anytime after that. Okay, let me help you understand some additional benefits that we have. So we've been talking a lot about the core benefits, the vested benefits, which is the retirement allowance, and there's that cost of living adjustment to the allowance and the $1,000 lump sum death benefit. There are also some additional benefits here that I want to talk about. There are these non-guaranteed benefits, so also known as non-vested benefits. So you can tell by the terms non-vested and non-guaranteed. These are not guaranteed, like the pension is. These are extra benefits that the county and the employers decided that the ACERA retirees, their retired employees needed to have, and so they started a reserve fund to be able to start offering medical, dental, vision, and other benefits. There's also disability retirement, which I'm not going to get into right now, but that is an option that you have if you become permanently disabled and you cannot perform your job duties. Instead of applying for the regular retirement, which also known as service retirement, you can apply for disability retirement. And if you're going to do that, you go ahead and go out to our website and research that some more, and then call in to our phone number and ask to talk to our disability unit to get your questions answered. And then there's some death benefits that we'll talk about. Okay, so I'm not going to go into any amount of detail on the medical, dental, vision, and other non-guaranteed benefits because the details change from year to year. Like the subsidy amounts change from year to year. The premium amounts that it costs to enroll in our healthcare plans change from year to year. So it's not that useful to talk about now since you're a ways away from retirement. What is useful to talk about right now are these numbers right here, the eligibility requirements that qualify you to be able to access these subsidies. So like I said, there's this reserve fund that pays for these extra non-guaranteed benefits, and it's the Board of Retirement's job to administer that fund and determine what the eligibility requirements are in order to keep that fund sustainable now and into the future. And so that's why this line here says the subsidies may be reduced or eliminated in order to keep that fund sustainable so that they can keep offering these benefits out to retirees. So that's the board's goal, is to keep the fund sustainable. So they've set up this set of requirements based on years of service credit in order to qualify for these benefits. So supplemental cost of living adjustment, which is a cost of living adjustment on top of the vested cost of living adjustment, and this keeps you from losing too much of your buying power in retirement. That does not require any amount of service credit. Everyone qualifies for that in retirement. But all the other ones start at 10 years of service credit. Okay, there's a Medicare subsidy, there's vision and dental subsidies, and then the first level of the monthly medical allowance, which is what MMA stands for. It's a medical subsidy. You need at least 10 years of a SARA service credit to qualify. And it specifically says a SARA service credit because reciprocal service credit is not included in here. So once you reach 10 years of a SARA service credit, then you start qualifying for these medical, dental, vision, and Medicare subsidies. And then additionally, if you achieve 15 and 20 years of service credit, the amount of medical subsidy that you qualify for goes up. I will say that this says full, it doesn't say 100%, because the medical subsidy currently does not pay 100% of the cost of being enrolled in our medical plans. So that's just something to keep in mind. If you want to know more about these, you can go out on our site and search for our annual enrollment guide, and that tells you all of the details about the costs and subsidies. I got a question: what benefits or options are there for dependents? You can enroll dependents in our healthcare plans, but there's no subsidies available for them. But I will say that Alameda County provides a higher level of these subsidies than any county in California. So if you do achieve 10 years of SARA service credit and you're able to start qualifying for these, then it's like really advantageous. It represents a lot of money in retirement, and at a higher level than any county in California. And so what I'm going to do here on the pension milestone chart is just add this date here. This might happen at the same time as this date, or before this date, but for you, depending on like what your situation is. But I just wanted to like throw it on there to just give you the idea that that 10-year mark does represent a lot of money in retirement. And so if you currently have like 9.5 years that you've worked and you're thinking about doing something else, you may want to stick it out another 6 months and get over that 10-year mark, because those subsidies will really help you out when you retire. Same thing with the 15 and 20-year marks. If you've worked 14 years and 6 months, maybe you get over that 15-year mark, go up and get a slightly higher monthly medical allowance. So the question is, when I say 1/2 of the medical subsidy, what does that mean? Or 3/4? That means that the Board of Retirement sets the amount of the medical subsidy every year. And like I said earlier, this currently and for the last, 8 years, does not pay the full amount of the cost of being enrolled in our medical plan. So the cost for early retirees who retire under Medicare age, the cost of the plan is $700 something, maybe $750, and the full monthly medical allowance is maybe like $550, and so it costs another $200 to be even at that level out of pocket. But then, so the 3/4 and half amount is the fraction of the full amount that this amount of years of service credit would get you eligible for. So it would be 3/4 of the 550 or 1/2 of the 550, or whatever the full number is. If you move out of California and have 20 years, do you still qualify for the monthly medical allowance? Yes. And in fact, we have health care options available for anywhere you live in the United States. So you can still plan on moving outside of California and being able to take advantage of these healthcare subsidies. And the question is, another question is, do you still enroll through the employer? And so the answer is no. We offer our own plans. They're the same plans, at least for the medical, they're the same plans that the county currently offers. At least for the group plans, the individual plans we offer, if you move outside of the area, there's additional individual plan options. but they are retiree plans. They're not the employer plan. So you get off your employer medical coverage and you go onto one of our plans if you want healthcare coverage through us. That's the way it currently works, but who knows what's going to happen in the next few years regarding national healthcare. That's why I don't go into a lot of detail during this seminar. Okay, so let me talk about designating your beneficiary or beneficiaries. A beneficiary is somebody who gets benefits. Your ACERA beneficiary is the person who you designate to get your ACERA death benefits after you die. So that's what beneficiary means in the context of ACERA. So this goes to answer the question, what happens if you die before you retire? What happens to your pension? Okay, so this is what happens. If you are not yet vested, what your beneficiaries would receive is a return of your employee contributions that you've paid into the system, plus all the interest that you've earned on that money, all the interest that we've applied to your account. Excuse me. Plus, your beneficiary would get 1 month of your salary for each year of service that you've already worked, up to 6 months worth of salary. So if you've worked for 4 years so far, then they would get 4 months worth of your salary in addition to the return of contributions and interest. And this is if you die as an active member. This isn't if you die as a what we call a deferred member, which is you stop working and you defer your retirement to a later date. Okay, so, and I'll show you what happens if you die as a deferred member on the next slide. Okay, so if you are an active vested member, so you've already achieved 5 years of service credit, or you're considered vested through Reciprocity, your beneficiaries would get a choice. They would get a return of your employee contributions and interest under option 1. So the option 1 is basically the same as the one that we just looked at. Return of contributions and interest plus 1 month of salary for each year of service, up to 6 months worth of salary. Alternatively, they could take option number 2 and get this monthly survivor's allowance, which is based on them getting it's based on you being it's based on the amount of service credit that you've earned up to the time of your death, and then based on the idea that you took and so then we would calculate the unmodified option for you, which is the highest option, and that option gives 60% to a spouse or state registered domestic partner, and so they would get 60% of whatever your retirement allowance would have been calculated up to that point. It's kind of complicated, but you can read more about it on our death benefits page. Option number 3 is a hybrid of options 1 and 2, and they would get the 1 month of salary for each year of service, up to 6 months worth of salary, plus a reduced survivor's allowance. If you are not an active member at the time of your death and you haven't retired yet, you're what we call a deferred member, because you've stopped working at your job, so you quit, or you're not working there for whatever reason, and you haven't retired from ACERA yet. You're still an ACERA member. You're just kind of on hold. Then what you would get is your beneficiary would get just a return of the employee contributions and interest. There's more info about that on our death benefits page. But regarding designating your beneficiaries, you're going to want to keep those designations current. You can, as active members, you can change your beneficiaries at any time. You do that on our beneficiary designation form. And if you want to check your beneficiaries, you log into your account on our website, and there's a nominated beneficiaries page. You can see who your beneficiaries are. If you log into our website and you check on your beneficiaries, and your beneficiaries is your spouse from 3 spouses ago, you're going to want to go ahead and redesignate your beneficiary. So you can find the link to the form right in this page. You click on the link, it'll take you right out to the form. Okay. So the next item on the checklist, understanding your career planning options. Okay, so this is we're gonna do two scenarios here. The first one is that you're gonna work straight into retirement. So you're gonna retire from a SERA, you're gonna work all the way up to your retirement, you're gonna go straight into retirement. So you're gonna earn service credit right up to your retirement. We're gonna do that sick leave conversion for you that I mentioned earlier. You get half of your sick leave to service credit. And you can even go work somewhere else if you want. That is not one of our participating employers. And we're just going to consider you retired and pay you your retirement allowance every month for the rest of your life. And then you can go earn money somewhere else if you want to, or you could just relax and enjoy your retirement. So that's scenario number one. Okay, scenario number two is you're not going straight into retirement. You're going to quit your job before retirement, or your job is going to end before retirement in some fashion. And so you actually become a deferred member. So we're going to add that to the pension milestone chart here, because if this is the scenario that you're going to take, there's going to be a gap here between when you're stopping working and when you're actually retiring. So you would earn service credit between your date of entry and the date that you leave, and not all the way up to your retirement. Okay, so you're going to have basically three options for your termination of employment. Options A, B, and C. Option number one is you become a deferred member, which means you leave your employee contributions on deposit with the SERA. So you don't take a refund of your retirement contributions. As a deferred member, the word member is in there, so you can tell that you're still an SERA member. Your interest continues to accumulate. We continue to pay interest onto your account. And in fact, we don't pay negative interest. So if a SERA's fund experiences adverse investment experience in a particular year, you don't see that in your account. We only pay positive interest. So it's a really safe place to keep your money, even if you're considering taking a refund later on and not retiring from a SERA. You can retire later. So if you stop working and become a deferred member, you can retire out of deferred status. So you can go from deferred membership into retired membership and start drawing that retirement allowance. Or if you don't want to retire later, you can come back to work and earn more money. And when I say earn more money, what I meant to say was earn more retirement. So as a deferred member, you're just kind of on hold. You're not earning service credit, but you're not paying retirement contributions into the system. If you come back to work for your employer or one of our other participating employers, you just kind of pick back up and you start earning service credit again, and you start paying into the system again. As a deferred member, you can retire later if you are eligible to retire, or you could decide to be refunded at any time. So that goes to answer that question that I got earlier, which is, can you take a lump sum retirement payout? Yes, you can. And that's actually going to be option C, which I'll talk about in detail in just a minute. So that's option A. Option B is establishing reciprocity with another retirement system. And we've referred to this a few different times earlier on in the presentation. Establishing reciprocity is the linking together of different retirement systems in California. So many of the cities in California can be linked together with the SERA, California state jobs, and other agencies that use the California state pension system known as CalPERS. Those can all be linked together, and you can find a full list out on our website. What the benefits of linking the retirement systems together are these three benefits. The first benefit is that the service credit that you earn in all the systems combined get you over the vesting requirements and the retirement eligibility requirements for all the systems. So if let's say that you worked at Contra Costa County for 5 years, and then you came over to a SERA and worked for 6 years. Okay, so that, what did I say, 5 and 6? So that would give you 11 years. That would get you over that 10-year requirement. And if you're over age 50, then you can retire. Okay. The benefit number 2 is that the highest salary that you earn under any of the reciprocal systems is used by all of the systems in their calculations. So let's take again that example. You work over in Contra Costa County for 5 years, then you come over to Acera, and let's say you work for 15 years. And then you go to retire. Over at Contra Costa County, that was 15 years ago plus. You were probably making a lot less money over there. Over here at Acera, your salary went up and up over 15 years. You're making a lot more money over here. When you go to retire, you submit a retirement application to both systems at the same time to retire on the same day. We're going to do a calculation at Acera based on your 15 years of service credit here, your age factor percentage here, and your salary here. Over at Contra Costa County, they're going to do a similar calculation. They're going to use your age factor percentage over there for your tier over there. They're going to use your service credit that you earned over there 5 years in this example, and they're going to use the highest salary, which wasn't over there. They're going to call Acera and get what your salary is here, and they're going to use that salary over there when they're calculating your retirement. So you're going to get much higher retirement for that work that you did over there than you would have if they had used that salary figure. And then so we both do the calculation and we both send you a check in the mail. And so that kind of goes to answer the question that I got earlier regarding the question was that you left San Mateo County after 5 years and you got reciprocity and you started working here, and now you've been working here for 8+ years. Can you roll over your retirement account service credit from there to here? And you can't, but you don't really need to, and you don't really want to, because you're already a member over in San Mateo County. You're already going to get a retirement based on that 5 years of service credit over there, but you're going to get a much higher retirement allowance because we're going to use your higher salary that you're earning here. They're going to use that in their equation. And so you don't really need to do anything because you've already done it by establishing reciprocity and taking advantage of the benefits of reciprocity. And the third benefit is if you're not in tier 4, it gives you a lower contribution rate because your contribution rate is based on your age at your date of entry in the earliest system. Plus, reciprocity could have gotten you into an earlier tier, like tier 2, based on your date of entry. So those are the advantages of establishing reciprocity. Now, in order to establish reciprocity, you got to do 4 things. You have to leave your contributions on deposit with every system that you're linking together. So you can link multiple systems together. It's not just 2. You could leave your job here, go out to a different system, link that one together, like get a job over in Marin County, link that together. Go work in San Francisco County, link that together. So you can link a bunch of systems together as long as you leave your money on deposit with all the systems, and no more than 180-day gap can be. There's no more than 180-day gap between you terminate your job at one system and you enter the next system, your entry date into the next system. 180 days is about 6 months. So as long as it's less than that, then you can establish reciprocity. So the third thing that you have to do is have no overlapping service. So if you're going to go out and get a new job somewhere else, you don't want to take leave, let's say that you have 5 weeks of vacation leave on the books. You don't want to go on a 5-week vacation and immediately start a job over there, because that's overlapping service. That'll disqualify you. And you got to retire from all the systems on the same day to keep reciprocity whole. And so those are the things that you have to do. Okay, so let me there's a reciprocity question here. The question is, you have reciprocity with San Mateo, but you only worked for 3 years there, and you were not vested when you left. So reading the slide, when you retire in 20 years, it would then be best I'm not quite sure I understand the question. It sounds like you worked there for 3 years. Now you're working here, and you're thinking that you're going to retire 20 years. So I don't know if that means 3 years there and 17 years here, or 3 years there and 20 years here. And the question seems to be about medical benefits. I'm not sure what their requirements are to be eligible for their medical benefits through their retirement system. For a SARA, it's based on the SARA service credit that you earned. So if you got over the 20-year mark for a SARA service credit, that would give you the 20-year full monthly medical allowance. If you didn't quite get there, then you might get over the 15-year monthly medical allowance. So I hope that answers your question. Let me know if it doesn't. Okay, so the question is, if you leave Alameda County and go work for a different county to work, for example, and you already have over 10 years of service credit at a SARA, in addition to establishing reciprocity, you need to declare deferred status with the SARA too. That's correct. So basically, you're doing option A and then option B, which is you're becoming a deferred member with the SARA by leaving your contributions on deposit, and then you're becoming an active member over in the next job, and then actively contributing to their system. So yes. And then there's one question regarding what do I mean by no negative interest? On the previous slide, what I mean is that if you take your money and you buy one share of Apple computer stock, if that stock decreases in value, then your account balance decreases in value. That doesn't happen at a SARA. So if a SARA's value of our fund decreases, our members' accounts don't see that decrease. If we didn't earn money, there would just be like no interest posted, but you wouldn't lose money out of your account, is what I mean by that. Okay, and then the question, does it mean that Sarah's investments are in the form of annuities? So an annuity is just like a guaranteed payment for the rest of your life. So in one sense, a SARA is an annuity because you are earning a retirement and it's calculated based on the formula, and so it's a defined amount. That's why it's called a defined benefit plan that you can count on. So in that sense, it's an annuity, but a SARA's investments are just a diversified set of investments that we invest all across the world. And you can read more about what we invest in on our investments page. And our goals are that you'll read about on the investments page are minimizing risk and securing your retirement regarding our investments. And then the question is, what happens to a SARA's investments when the value of investments decrease? Sometimes that happens. Like that happened, this year for everyone who is invested in the stock market. The value of your investments decreased, but it's a SARA is a long-term investor. So we are investing over the long term. So sometimes the market is up, sometimes the market is down. And our strategy is based on long-term investing. So if you look at how much we earn on an average basis every year, so for example, every year over the last 25 years, on average, we've earned 7.9%. And that included some times when the market was way down, like the Great Recession and the recession after September 11th. And so that period included those times. But the market goes down and it goes up. And so on average, even considering those things happened, our investments have earned an average per year of 7.9% per year, each year. For example, the year before last, I think we earned maybe like -4%, if I remember correctly. Last year, we earned 18%. So you can see that the amount that we earn goes up and down. But since we're a long-term investor, we're looking at the long-term horizon and the ability to pay our long-term amounts that we owe to our retirees. And so that's why we're investing over the long term. So yes, the value of Acera's investments may go up and down, but your retirement is secure in that we're investing for the long term, and that money is going to be there when you need it, and it's guaranteed by law. If we experience adverse investment experience, then the employer is on the hook for contributing additional funds to make sure that we have the amount of money that we need to be able to pay out the amounts that we owe to our retirees. Okay. So we talked about option A and option B for if you terminate your employment. Option C is that you have the option of taking a refund of your contributions and interest. So you can take, so it's paid out in a lump sum payment. If you do take a lump sum payment and you're just looking for cash, you may lose about a third of your money to taxes and penalties, just right off the top. If you don't want to lose that money to taxes and penalties, what you could do is you could roll over that money into another eligible type of retirement account, pre-tax retirement account, like a 457B, 403B IRA, or 401k. Refunds take 45 to 60, sometimes more than 60 days after you stop working to process. So it's not an instantaneous thing. If you take a refund, what you're saying is that you waive your right to all of the Acera benefits. So you don't want to retire. You don't want to have access, if you have at least 10 years of service credit, to those Acera subsidies. You don't want to be able to enroll in our healthcare plans. You don't want access to the death benefits. You want none of that. You just want to take your contributions and interest. So yes, you have that option. If you recall, in the beginning of the presentation, I told you that if you do retire from Acera, you're going to get all your money back anyway. All your contributions and interest, you're going to get all that back through monthly retirement payments within your first 3 to 5 years of retirement. So if you're eligible to retire, it doesn't make a lot of sense to take a lump sum payment, because you're going to get, first of all, you're going to get all your money back within that first 3 to 5 years, and then you're going to get a monthly payment every month for the rest of your life. If you retire another 30 years after that first 3 to 5 years before you pass away, that's pure profit for you. I mean, there's no other investment that you can probably find that works that way, that you can get that amount of benefit. So yes, you do have the option of taking a lump sum payment, but it's probably not that advantageous for you. It may be advantageous for you if you haven't worked here, if you're going to stop working before you're vested, and maybe you can find something to do with your money, because if you stop working before you're vested, you're not going to be able to retire before age 70, and so maybe you can find something to do with that money that would earn you more prior to the time you retire, if you're going to retire before age 70. So that might be a scenario where that might be advantageous. But if you are already eligible to retire, or you're close to retirement eligibility, it's not really advantageous for you to take a refund of your contributions and interest. Okay, so there is a question up on the board. Can you retire, take another job, but not receive monthly benefits until later? No, you can't, because as soon as you retire, we need to start paying you your retirement allowance payments. Now, that doesn't mean that you have to spend it. We'll just deposit a new account for you, and then you could take that money and you can invest it for later. So, feel free to do that. If you're gonna stop working here, like, so let's say at age 50, and you're ready to retire and you're not gonna work here anymore, and you're ready, you can just go ahead and retire from Acera. We'll pay you that retirement allowance, and you just take that money and invest it, and then go work somewhere else. So that's one way to do it. Let me say, well, actually, we're running out of time, so yeah, let me move on. Okay, so now we've reached the part of the presentation where we're going to talk about making a retirement planning picture. So this can be stressful. So if you want to take a deep breath, this is actually not that complicated. This is not rocket science. This is just so I'm just going to tell you what I know about this. This is just one way of thinking about this. Um, so if you have a different way of thinking about this, or if you want to go out on the internet and explore different ways of creating that picture of your future retirement, or determining how much to save, this is just the way that I have come up with, and so this is just kind of my opinion. So this is basically the slide again that we saw earlier. So this is a picture of your future retirement income. So you're going to stop working and your employer is going to stop paying you. So you're going to need income to live in retirement. So where's that income going to come from? So one of the places it's going to come from is your SARA monthly pension. Since you're an SARA member, you're earning a pension and you're going to collect that one day. So that's going to be part of your income in retirement. Social Security, if you're paying into the Social Security system, you're going to be able to collect Social Security one day. So that is another source of income in retirement. And then everything additional beyond those is going to be your personal savings and investments. And so again, what financial planners will tell you is that you're going to need 70 to 80% of whatever you were making before retirement. You're going to need that income in retirement to be able to maintain your standard of living. And so right now, since we're looking at your future retirement, and since this is kind of mid-career / new employee thinking, and we're looking at your future retirement that's a ways away, we can do some things in order to paint a picture of what that retirement is going to look like, retirement income is going to look like in the future, and help you figure out what this number is a target amount of savings that you might want to save. So the way that we're going to do that, the first step is you need to get an SARA estimate. So you go ahead and do what I showed you earlier. You get an SARA estimate, and you're going to want to kind of note a good way to do this is to get out a piece of paper and just kind of note these things down, because we're going to plug these things into a retirement calculator. So you're just kind of like when you do this on your own. So you're just going to want to go get an SARA estimate, and then you're going to want to go get a Social Security estimate. So for the SARA estimate, again, you log into our website, you get the estimate, you end up with the SARA benefit estimate, and you're going to look at the retirement estimate allowance number, and then you're going to also just kind of want to look at your average monthly salary that it's projecting for you and your age at retirement, and just kind of note those three numbers. The reason that you're going to want to look at the salary number is because if you divide the little number by the big number, that will tell you what percent of your retirement allowance, that will tell you what percent income replacement you're getting based on this scenario that you're doing. So you put your estimate number in here, you put that percentage number in here, and you put your age in here. And then you're going to want to go get a Social Security estimate. And there's a question, will this presentation be available to watch again? Yes, we'll post this on YouTube and post a link out on our website to this, so you can watch this again. So you go out and get a Social Security estimate. And so you go to the Social Security's Estimator. You go through the steps, they ask you a bunch of questions, and what you end up with is a page that looks something like this, where if you retire at different ages, it gives you different amounts that Social Security will pay you every month for the rest of your life. Okay, so for this one, we're just going to kind of want to look at we'll look at kind of the 62-year-old amount. So it's about $1,700. So you can plug those numbers in here. So you just write all these numbers down. And what you're going to do is you're going to go out and try some retirement calculators. We don't have one on our website yet, but there's a bunch of different ones. You could type in retirement calculator into Google. A bunch of them will come up. I've linked some here. If you belong to the county's deferred compensation program, you can use their prudential retirement calculators, which are pretty powerful once you log in there. So you can try these links out. I'm just going to show you the Vanguard calculator right now. And I think instead of showing you the screenshot, what I'll do is I'll just share my screen and go out to that. page. And so I'll just show you kind of how these things work. And let me know if you can't see what I'm talking about. Let me know if you can't see what's happening. Okay, so here is the Vanguard Retirement Calculator. And you can see that it has these sliders, and it's going to ask you for numbers. So let's say that you're 30 years old, you're going to retire at age 62. And let's pick a nice round number. Let's say that you make $100,000 a year. So you're going to leave this slider alone for now. Okay, now you put in here how much you've already saved for retirement. Okay, maybe it's 0. That's okay. Don't worry about that. If it's 0, it's 0. But maybe you have, let's say in this scenario, maybe you saved a little for retirement. Let's say that's about $15,000. And let's say that you want, so this is the income replacement amount that you want. So this should be somewhere between 70 and 80%. Let's go on the low end and say 70. And then it's going to ask you how much expected annual returns you're going to get from your investments, or you're expecting from your investments. This is kind of asking you about how much risk you would be willing to take on with these additional investments. This number, you're probably going to want to pick a number between 2 and 7%, because 2 is like on the low end of what you can get if you have like a high yield savings account. 7% is kind of like on the high end if you have, kind of more conservative estimates. At Acera, our investments, our assumed rate of return is 7.25%. So we assume our investments are going to earn 7.25% a year. So we try to kind of reduce risk, and so that's kind of where we land on that. So let's just say 6%, just to keep it a little conservative. And then these 2 boxes, this is where you plug in some of those numbers that you collected. So this is going to ask you about how much your estimated Social Security income benefit is going to be. So if I recall correctly, it was about $1,700 in that example. And you can see that the orange bar over here popped up immediately. Because now it's showing you, so this bar is what you'll need, and this is what you are going to have. So it's plugging Social Security in there to try to get you up to here. Then you can come over here and put in your pension benefit from Acera. Okay, so we had noted that I think you were getting 20% of your salary. Let's just say 30% of your salary in retirement. Okay. So then the pension part of the equation pops up. Okay, so your job is to fill in this gap. And then you do that with this slider here. This tells you how much additional you're going to need to save annually in order to get up to that amount. And so you just kind of get them even. This is telling you that if you're earning at this rate, 6% a year, if you invest your money and you're earning at 6% a year, you're going to need to save an additional $8,500 per year during this period, while you're earning this salary in order to hit this goal. $8,500. Let's see. Divided by 26 pay periods, that's about $326 per pay period. So it's not a huge amount that you would have to set aside per pay period in order to hit that target in this example. So that's how that works. These numbers are all going to be different for you. You just play around with the sliders, try out different calculators. So we're back on the slide show here. Let me know if you can't see the slides. So try out different calculators. They'll all get you at kind of a different number, but try out the ones that let you put in that Social Security amount and let you put in that Acera pension amount, because it'll show you, it'll use those 3 things to get you up to what you'll need. And what they usually call these 3 items are the 3-legged stool of income replacement. So Social Security, your pension benefit, and then additional savings. For some of you, if you're going to work a long time and earn a lot, you're going to work 30, 35 years for a SARA, this yellow part is going to be huge. And you're probably not going to need to save that much additional money. You might actually be able to get to that 70 or 80% between your pension benefit and your Social Security benefit. But we find that our average a SARA member retires with 20 years of service credit, and so that doesn't quite get you there. And so you would need to save additionally while you're employed in order to hit that target. Now, this is not an exact science. This is more of an art. What this calculator is doing is getting you pointed in a direction, getting you pointed in the direction of 70 or 80%. What I suggest you do is do the calculator now, get pointed in that direction. Maybe you can't save what it's telling you to save now. You just get pointed in that general vicinity. Come back a year later, do the calculator again. It'll get you pointed in a slightly different direction. You change your amount of savings. Do it again a year from then, or you could look at it every 6 months. And you just kind of change your trajectory periodically based on what it's telling, excuse me, the additional amount that it's telling you to save. And eventually when you get there, when you get to retirement, you're going to be in that 70 to 80% territory. So that is kind of how I view these things. Okay, so now, now that we've kind of talked about like how to determine how much additional money to save, let's talk about where you might want to save your money. Because if you're saving additional money, you're going to be parking that somewhere. So where might you want to put that money? So one line of thinking, and you don't have to do this, so this is just one line of thinking. This is, kind of my opinion and a lot of people's opinion, is that you might want to put your money somewhere that it can possibly earn interest. If you put earning interest is where you basically loan your money out to someone else, and by loaning your money out, you have the ability to get a return on the fact that you've loaned that out. Like you loan your money out to a bank by buying a certificate of deposit, and they'll pay you some interest in order for, because you did that, some small amount of interest. If you earn interest, it helps you do two things. It helps you beat inflation, which tends to be around 3% a year under normal circumstances. Like who knows what's going to happen now that the Fed is just printing money. But under normal circumstances, it tends to be around 3%. And it also helps you earn more money through compound interest. And so if you look at a compound interest graph, it looks like this. If you just saved $1,000 and you didn't earn any interest, at the end of 20 years, you would still have $1,000. So if you just put cash away. But your money would actually be worth a little less because of inflation over that 20 years. So if you put your money in something that earns interest, if it wasn't earning compound interest, it would just look kind of straight. If you earned, this is assuming you're in 10% on $1,000, you just earned 10% on $1,000 over 20 years, you would end up with $3,000. Now, compound interest graphs always look like this because they curve up, they accelerate because you are earning some money. You're earning interest. And then if you keep that interest amount that you earn invested, you're going to earn interest on top of that interest. And then if you keep that new interest invested, you're going to earn more interest on top of that new interest. So it accelerates, and you end up with a lot more money at the end if you successfully are able to earn that compound interest. But be cautious, because whenever you have the potential to earn interest, that includes the risk, financial risk, that includes the risk of not earning interest, that includes the risk of losing money. And generally what they say is that the higher the opportunity to potentially earn a return on your money, the higher the risk. Okay, so it's up to you to be cautious with your money. I'm just kind of giving you kind of an overview of the thinking on this, but it's up to you to do the research to figure out where to put your money. Okay, so one place that you can put your money that you can choose, I call it diversified risk options, because you can choose low risk, you can choose a little bit more risk, and it's up to you, is you put your money in one of these defined contribution accounts. And the main one that we're going to look at is the 457B account, because you all as public employees have access to a 457B account that you can save additional money in. And you can access that and open the account by going to this link on the county's website. When you contribute money to that account, you're contributing tax deferred dollars. So if you contribute $10,000 to your deferred compensation account this year, that lowers your tax liability this year by $10,000. You don't have to pay taxes on that $10,000 yet. You'll have to pay taxes on disbursements from that account later, but it lowers your tax liability now. And you can contribute a maximum in 2020 of $19,500 per year. So you can put away quite a bit of money in that account per year. And then one of the things that's good about lowering your tax liability now and not paying taxes on that money now is it helps you accelerate that compound interest a little bit faster, because that money that you would have paid in taxes, now you're contributing to the account, and that's a little more money they're earning a little more interest. One more thing I'll say about deferred compensation accounts is once you get in there are some, you can choose the different risk options, and it's kind of easy. It helps you walk you through it. And there are some like very low risk options that tend to earn, kind of low interest around 2%, but you could put your money in there if that is the amount of risk that you can stomach, because at the end of the day, you want to be able to sleep and you want to know that that money is going to be there when you need it. And so you're just going to want to, choose the amount of risk that you can live with. If you don't want to save your money in the deferred compensation account, or you've already maxed out the amount of money that you're saving in deferred compensation, which would be great, and you have additional money that you can save, there's some pretty low risk options that I'm listing out here that you can think about. And it's noon right now. We'll just go an additional few minutes. So if you need to leave, feel free. Like I said, the recording will be available later, but it'll just be a few more minutes. So some of those options are like high yield checking accounts and high yield savings accounts. These are not different from regular checking accounts or savings accounts. They're just checking accounts and savings accounts. It just so happens that there are some banks out there that will actually pay you interest for you opening a checking account or savings account. And you can search for those. A really great way to search for those types of accounts is to go to places like NerdWallet, and they will tell you what banks have deals right now that will get you into a higher interest account. They typically pay less than 1.5%. It's not a huge amount of interest, but it's more than you would get under a normal checking or savings account. There's also what they call money market accounts or money market deposit accounts. These are essentially the same thing as savings accounts, except for there are some checking features that you get. Like you'll get a debit card and you can write a certain amount of checks or make a certain amount of debits. They're pretty much the same as savings accounts. For some reason, I'm not sure why. Currently, when I looked at the rates that they're offering, you can get a tiny bit more interest under the money market accounts rather than the high yield savings accounts. I'm not sure why. Okay, then there's this option here, money market mutual funds. These are two different things. They have the same money market name here, but this is a completely different thing. These three are all FDIC insured. Your money is not going to decrease. If the bank goes insolvent, the FDIC is going to, which is the federal, I don't remember what it stands for. It's the federal government's insurance, Federal Deposit Insurance Corporation, I think. And they just insure the balances if the banks become insolvent. And so up to a maximum, like I think $200,000 or something per account. This is not insured. This is a type of account that you would get through a brokerage account. Like if you go out to Vanguard and you open a brokerage account, they would have a money market mutual fund option for you. And it's what they do is they invest money, but it's in things that are considered pretty low risk. And you might be able to get a slightly higher return there, but this does come with risk, so keep that in mind. I did look at a few of those last night, and I saw that even through this sharp decline and slight uptick in the markets this year due to the coronavirus, the funds that I looked at just kind of maintained a steady increase throughout that period. So I'm not exactly sure how they work, but people do say that they are, slightly lower risk options. Again, it's up to you to do the research and determine if that amount of risk is something that you can deal with. Okay, certificates of deposit, also known as CDs. These are also FDIC insured. They typically earn less than 1.5% when I looked at them last night, and that's for a year. So you kind of lock your money away for a year at a bank with a certificate of deposit. It's kind of locked away. You can access it in an emergency. It's just you pay a penalty on the interest that you would have earned. And then there's also treasury bills and notes. Those are backed by the U.S. government, and bonds, and those kind of pay variable rates. You can do more research on those. None of these things pay that much interest, but we thought we'd put it out there just so that you have a few lower risk options to park your money. But again, do your research and remember you're solely responsible for the investment risk that you take on. So regarding what's happening in the market right now, nobody knows what's going to happen with the stock market right now. Nobody knows. Warren Buffett doesn't know. Nobody knows. So this, I'm giving you the normal spiel that we usually give in this seminar about trying to earn interest and investing your money, and possibly taking on some risk to earn more money in the stock market or wherever you want to park your money. But maybe this is not the time for that. So be extra cautious right now. Do extra research. The way that you do research is just use Google and just type in every question that you can think of about how to keep your money safe, what to invest in, what the market's going to do. Read all the articles that you can read, and just be extra cautious right now. I mean, right now might be a good time to just hang on to your cash and not invest it anywhere. Park it in a high yield savings account, maybe. Okay. To earn a tiny bit of interest. So, and when I say cash, anything that's FDIC insured, that would be considered basically cash, where you're earning a little bit of interest. If you want more help, I've kind of exhausted the depth of my knowledge on this subject. I'm not, a big expert on this. That's kind of all I know about this. A good idea is to consult the experts. So if you sign up for or you're already enrolled in the deferred compensation program, they have free financial planners. You can meet with them as many times as you want. They will even, from what I've heard, give you advice on investments, or maybe not advice, but they'll give you information on investments that you don't even have in the deferred compensation program, just as a courtesy. But they will definitely give you advice on how to allocate your money in the deferred compensation program, and kind of help you through the process of financial planning. If you sign up for an account with the First United Credit Union, they also offer free financial planners as well. So that's another option out there. You can also hire a financial planner, but if you are going to do that, look very closely at the fees that they're going to charge you. Because some financial planners out there, they'll charge you a percentage for investing your money for you, maybe even 1%. That can really cut into your compound interest over time if they're charging you that much of a fee based on that 1%. So be very, very careful with that. There's more information on retirement planning. There's an expanded article on our website if you go to estimator.org/start here. And then the Federal Deposit Insurance Corporation, thank you. And then, so this is just one item on the checklist. Start a 457B account if you want to do that. The minimum amount to start a 457B account is $20 per paycheck. So you don't even have to start out with that much money. You could just start out with $20 for now. You could put it in the part that they consider safe. I think it's called the stable value fund. They consider that pretty low risk, and you could just start there, and then you could just ramp it up over time. And then I think you'll find that if you put that $20 away, you won't really miss it. And then if you increase it by $20, in a few months, you won't really miss that. You'll just adjust to having a little bit less to pay for your expenses and like during this time, and you can just like adjust it up from there, and then you can save more money. Okay, so I have one more question. Are the retirement payments taxed? Yes, they are taxed, because you're paying contributions before tax, so you're going to have to pay taxes on the disbursements coming out. So your retirement allowance will be taxed. It's not a special tax rate, it's just the regular tax rate, whatever the tax code is at the time of your retirement. You would just look at the tax brackets to see what rate you're going to pay for in the various brackets, and that's how it would work. But you will probably pay less taxes in retirement because most people make less money in retirement. So you probably pay less total taxes, and probably a lower rate. And then regarding, there was one more thing I wanted to say on that. The way that we do it when you're retired is we send you a 1099 every year in January, and that's what you use to file your taxes. Okay, the last item on the checklist is sign up for Acera email news. So we don't send out a ton of news. We're not sending you something every week. We hardly send out any news. We only send out the important stuff. So if you want to keep up to date with what's going on in Acera, and if there's any changes in what's happening in Acera, we'll keep you updated if you subscribe to our email news at acera.org/subscribe. Otherwise, you could just continue. You could just visit our news page on our website to see what's going on with Acera. If you have more questions, you can call us at any time, 510-628-3000. Currently, during the shelter-in-place period, we are only taking live calls on Tuesdays and Thursdays. But if you're watching this video after that period, check our website to see when we're taking calls. But we will get back with you within one business day if you leave us a message and we're not available. And then we wish you a fulfilling career. We wish you a happy career. We wish you a happy future retirement. So check out our website for more information, and feel free to give us a call with any other questions. Thank you very much for watching the seminar.